I went from broke to financially free in my 20s, and it wasn't luck. It came down to the way I invest in stocks. Let me show you the three things I always look for before I invest. I'll break down the exact framework I use, the same one that helped me grow my portfolio to over 400k in just 5 years, and why it works no matter what the market is doing. So back around 5 or 6 years ago, when I started, I was chasing hype in the most popular stocks. I would buy the names that everyone was buzzing about, and I would always end up losing money when they crashed. The turning point for me was when I stopped guessing and built a simple system. I started asking, does this company actually have real growth power? Can it survive bad times? And am I paying the right price? And that's when everything changed. My results went from losing money on hype to stacking consistent wins and gains and reaching financial freedom in my early 20s. And in my investments, the first thing that I look for is durable competitive advantage, or Buffett would call it moat. Without a moat, competition eats away profits until there's nothing left. With a moat, companies can raise prices, survive downturns, and keep winning for decades. That's why Apple's iPhone's ecosystem locks you in, and that's why Costco's membership model creates loyalty, and why Visa dominates payments without almost no real rivals. In every cycle, companies with wide moats survive recessions and come out so much stronger. The second thing I look for is financial strength. In bull markets, even weak companies look fine because cheap money bails them out. But in the late stage of 18.6 year cycle, like where we are right now, debt becomes extremely dangerous. Margins compress and weak balance sheets get exposed. That's why I check net margins, return on equity, and free cash flow. If a company has double digit margins, high ROE without excessive debt, and consistent cash generation, it tells me that the company can weather storms and still grow. The third thing I check is valuation. The best company can still bankrupt you if you overpay. For example, Cisco in 1999 was trading at 100x earnings. Great business, terrible price. 20 years later, investors were still waiting to break even. Buffett's rules is very simple. Don't confuse a wonderful business with a wonderful stock. I would rather buy a great company at a fair price than a fair company at a wonderful price. The way I check is comparing P to E ratio, P to free cash flow ratio, and growth rates against the industry. If it's getting stronger and stronger, I know I'm getting value. And that's my framework for picking stocks: moats, financial strength, and valuation. I break these down every single week with cycle insights in my free newsletter, link in bio. Now I want to hear from you. When you look at a stock, what's the one thing you always check first? Comment down below, I'll be checking.